Hello, everyone. Welcome to Borrowing as a Business. You are in Strategic Boardroom. My name is Mark Dolfini, and it is really good to see you. Sorry for starting a couple minutes late. I was having some really horrendous technical difficulties. My lots of different things wouldn't work all at one time, but we are here now, and we are going to get started. We're going to get right into it because I've got a lot of information to pass along to you, and in a short period of time. So for those of you who are just joining me, I've got people broadcasting. Let's see, I've got Facebook up, I've got LinkedIn, YouTube, and of course people who signed up through EventBrite. It is good to see you. So please let me know who you are, where you're from, and what line of work that you're in. And if you're interested in borrowing as a business, you are in the right spot. And why is borrowing so important? Maybe you've got a business idea and maybe you're looking for funding. Maybe you're already in business and you're looking for a way to fund future growth. Maybe you're just tired of funding everything off of your personal credit cards. Ask me how I know. I get that. So I just want you to understand that borrowing is incredibly important because borrowing and the proper use of leverage allows you to accelerate growth, but only if the lending makes sense. And what do you mean? Like, of course you can leverage things, right? This is where you can grow much faster with leverage, but the thing is, levers can go both ways, right? Something comes down, you go launching really far if you're too far levered out. So by the end of this webinar, you're going to have a very good and basic understanding of how to get lenders to say yes, even if you've heard no before. Now, I'm not going to be able to teach you everything I know, but I'm just going to say I'm going to give you a lot of helpful hints along the way. And if you have been funding operations entirely on your credit cards, listen, I get it. I understand why it happens. I understand how it happens. And I have done that myself. I have started businesses using my personal credit cards, but it's like, it's time to graduate and move out of your mom's basement, right? Like that's kind of what moving off of your credit cards is like, and moving into more business funding. So if this is something that you can relate to, please let me know. But you might be thinking, well, yeah, lots of businesses, lots of business owners I know use their credit cards. And I'm not suggesting that's even wrong. I mean, I run quite a few charges through my credit cards, and I like the credit card points, right? I use those points to buy precious metals and stack that. But this is the interesting thing, is that the problem with credit cards is when things start going sideways and you get those, when you have a lot of revolving credit, which is basically, or I'm sorry, where it starts to stay on your credit cards, like you get over your skis, and because you have a growing business and growing businesses draw cash, they draw cash out of the business. Growing businesses actually have a need for cash, even though they think, wait, I don't understand, I'm having higher sales, shouldn't I have more cash? It's actually counterintuitive. It actually takes cash to grow those revenues, and that's very counterintuitive. But once you understand how that cycle works, you start to realize, oh my gosh, this is how I wound up with credit card debt I just cannot seem to get rid of. And the problem with this is I hear this a lot, and I'm not here to trash anybody, but when I hear like Susie Orman or Dave Ramsey, they mention people trying to get out of their credit card debt, and they have to get out of credit card debt. They're only telling you part of the story, and they're not wrong, but they're not telling you the whole problem. The problem with credit cards is certainly the interest rate. Everybody knows the interest rates, 18, 19, 20, 24%, whatever they can get away with, basically, right? But the problem is something known as a high loan constant. And a loan constant, the best way that I can describe this is, let's say that you borrow $1,000 and you borrow $1,000 on a mortgage. When you're borrowing $1,000 on a mortgage, because it's spread over such a long period of time, that costs you cash flow wise about $8 for every $1,000 that you borrow. Again, back of the napkin math. Of course, terms matter and rates and all the things. And I'm just saying, on average, back of the napkin, this is kind of what you're looking at, is $8 per thousand. When you're looking at a credit card, on the other hand, you're looking at borrowing for every $1,000, it's about $30 per $1,000 borrowed. So the problem becomes down to the minimum payment. So if you have this revolving credit and you just cannot seem to get out of it, this is why. It's because you have borrowed money on a very high loan constant debt. In fact, it's usually the highest loan constant debt that you have, with maybe the only exception of automobile debt. And automobile debt, because the timeline is so compressed that it becomes really problematic to actually, like, again, you've got this $50,000, $70,000, $80,000 vehicle that you've compressed into a 5, 6, or 7 year loan. So that by virtue of that, it actually compresses the loan constant. So either way, I'm just saying it becomes very, very expensive. So if you have heard your loan officer say no, your bank say no a lot, listen, they're not saying no to be jerks. Well, sometimes they say no to be jerks, but don't take it personally, because bankers are actually in the business of managing risk more than they are loaning money. And you think, well, that doesn't make any sense. Why are they in the business of managing risk? Because they are extremely heavily regulated. And yes, they are in the business of loaning money for sure, but they have to manage risk more than any other thing. So if they're loaning out money and not really paying attention to where that money is going, that becomes a real problem. Then you're thinking, well, how do I know this stuff? Well, I worked as an underwriter in the commercial lending department for a number of years at a, I would say, regional size bank at the time, but now they're almost becoming a national bank. So I worked for Union Planners. They ended up divesting and becoming Regions Bank. I worked for both banks for a period of time, and it was a great experience for me as a young accountant trying to learn the ropes, especially with lending. But the thing that is interesting is that I didn't understand how much that bankers were really in the business of managing risk until I actually started working there. So what I'm going to be teaching you today is some of the things that they just don't tell you. And it's not that they're trying to not tell you because they're jerks. It's, well, maybe they're being a little bit of jerks, but they're also, it's because there's so much to know. So I'm going to do my very best to give you this. Here's one quick thing I'm going to say, though. I do have an offer at the very end for a financial literacy course. If you are interested, I'll show you what it is. And it's going to explain a lot of this stuff in super, super detail. If you are interested, we'll talk about that here at the end. All right. So a lot of the stuff that I have written about or talked about is in this book, not necessarily about borrowing as a business, but just overall structure in your business. And this is on the Viper framework. I'm going to talk about the Viper framework here in just a second. But the main thing that is the reason I'm bringing this up now, if you are looking to get a much clearer understanding, a much clearer strategic framework for your business, you can check this out on Amazon. If you're outside the United States, that's probably your best bet to get it. If you're inside the United States and you'd like to get a signed copy, you can go to strategicboardroom.com and order it straight from the main page. All right, so that is the book. I'm not here to promote the book. I just want to let you know that people ask me about the book all the time, and I just want to make sure that you know how to get a hold of it if you were interested. All right, so the Viper framework is what is in that book that I just talked about. That's what we're going to do, a real quick summary of what that is, because it's important that you have an overall framework that makes sense for the lender. And why does that matter? If you don't think that they're going to look at your business and make sure that it's well organized and well running, especially if you're looking at a commercial loan, you're kidding yourself. They are absolutely going to be looking at that, and they want to make sure that you are structured, that you know what you're talking about. They want to make sure that you're an adequate risk. Remember, they're in the business of managing risk. They're not going to just throw money out on some whimsical idea that you have or had while you were standing in the shower. This is something that they're really, I mean, this is where you're starting to take things into the major leagues. And I'm just letting you know, they're going to look at your business, especially when you're looking at a business loan in the hundreds of thousands and even millions of dollars. They're going to start to peel through all sorts of different things in your business that you never thought they would. So if you're using your business credit card for everything, I mean, don't be surprised. They start looking at your financial statements and going, what are all these charges at Victoria's Secret for? Right? I mean, they're going to look at stuff like that, and they will at times. So I'm just letting you know that is certainly a possibility. So the Viper framework we're going to talk about, then we're going to talk about the 4 core functions of business, and then we're going to get into the financial statements that you need to understand at a deep level when you're looking at your business. So when you can understand your financial statements, it's really important that you understand them, because they are going to be asking you questions about them. So we're going into the financial statements. And I want to give you, for those of you who are on the call, and a bunch of people just joined on YouTube, just saying hello. If you're interested, say hi and let me know what kind of work that you're in. We're talking about borrowing in the name of a business today. So the financial statements, it's really important that you understand the financial statements. And you're like, oh, I'm not a numbers person. I don't know how to do this stuff. I respect that, but I'm just letting you know that accounting and bookkeeping, it's not about numbers. It's about rules. And if you understand simple games like Solitaire and Candyland and things like that, you can learn all this stuff. It's really not that difficult. You just got to learn the rules of it. That's it. So we'll talk about financial statements a little bit, and then we're going to get into the underwriting and lending, and specific what your banker and lender is going to be looking for and why that is. And then we'll talk about a couple of success strategies here at the end. So let's get into it. We've got the first and foremost, we're talking about the Viper framework. In any business approach, there is a systems approach and a psychology approach. So it takes both systems and psychology. I'm not going to get into the granular details on all these things today. I'm just going to give you a high level view of the systems and just understanding we'll talk a little bit about psychology along the way, but the systems approach is really around this framework of Viper method, the Viper method, which is vision, infrastructure, process, execution, and reporting. And that is a top-down look in your business and how you can set your business up. That is in a strategic manner, not just whimsical. Well, I did this because I felt like this was the right thing to do, and blah blah blah. No, this is a very strategic framework that you can set up for your business. So if that is something that is interesting to you, then pay attention to this. Now, I'm not going to get into, like I said, the granular details. This is outside the scope of this particular session to get into the Viper framework and into the weeds. But like I mentioned, you can either look at other videos or you can check out the book. But the vision piece has two components. It's got personal vision and it's got business vision. Personal vision is just basically that where do you want to go in your life? Like, Jeremy, where do you want to go? Michelle, where do you want to go in your life? What do you want your life to look like if your job description wasn't also a life description, right? Like what you do for money doesn't have anything to do with you. So I really want you to think about what you want your life to look like if it wasn't defined by income generation. And that's a really important consideration when you're building this business on the back end, because what ends up happening is people will oftentimes, they never really create a personal vision, and then their business vision becomes their personal vision. And the danger in creating a business vision without giving any consideration to a personal vision is that you end up creating a life that exists to serve the business. And I'm just telling you that sucks. Like it's a empty well that just never gets filled in. So please take some time to consider your personal vision. When you're looking at business vision, there's 3 C's of business vision. And I'm mentioning this now, even though you're thinking, well, what does this have to do with the price of tomatoes when it comes to borrowing in the name of a business? It has a lot to do with it, because what I'm about to define here for you, the 3 C's of business vision, anytime I see dysfunction in a business, when I get hired in as a fractional CSO or a strategist, I like being hired in as a fractional CSO, Chief Strategic Officer, because it pays a lot better. But either way, I mean, whether they're paying me, a few $100s an hour or $1,000 an hour, the difference here is every single time I come into an organization and I see these 3 C's, when there's a hole in the system somewhere where they've got a lot of turnover with their staff, when they've got a lot of turnover with their clients, when they have trouble capturing leads, when they're not profitable, it's usually a hole in one or more of these 3 C's of business vision. And those 3 C's are core purpose, core values, and client avatar. You've got to get really dialed in terms of what each of these 3 things are. Your core purpose is specifically what the business is about. And it's really important that you're really specific in that, not just, I'm in real estate. That doesn't tell me a whole lot. If you say, like, I'm a realtor that sells residential real estate on the south side of Miami in this specific school district, I'd be like, okay, you've got my attention. Like, that's a really clear core purpose in terms of what it is that you do. Core values is about what you stand for in the business. And that's really important to start to think about. Because let's figure it, like, your business is just an extension of you, right? So because your business is an extension of you, when your core values are defined, they should also very closely mimic the core values of the business. So again, you really need to take the time to start to define what the core values are, because again, if you don't define the core values in your business, they will be defined. They will generally be defined by the strongest personality in the room. And if that's not always you, that becomes a problem. So please take time to actually start to think about what the core values of the business are. And again, the reason for this is because core values help determine the company culture, and the company culture and the company brand have an inextricable link. And the company brand is what really determines what type of people come to your company. And not just in terms of your customers, but also the people that come and work there. So that is your core values. So we talked core purpose, we talked core values. Now let's talk quickly about client avatar. Client avatar is who ideally you want to work with. Think of them in terms of geographics and demographics and psychographics. Geographics is where they are. Demographics is who they are. Are they single? Are they married? Are they young? Are they old? Are they rich? Are they poor? Whatever. Like, what are their demographics and their client? And then finally, the psychographics is how they think and how they buy. Like, what do they think about your industry? What do they think about your company? What are their attitudes towards your company or your industry? Their lifestyle. What's their lifestyle like? What are their interests? Do they like NASCAR or do they like Formula One? And what are their goals and aspirations? If you know these things about your client and you know them well, it's going to be a heck of a lot easier for you to sell to them. So I'm just bringing this up now because all of these things together help define the DNA of your company. So that's the vision. The next piece of the Viper framework, we talked vision, which is V. Then we talk infrastructure. Infrastructure is the bones of the business. It's your desks and your chairs and your software and things like that and your websites. And generally, if you're making infrastructure improvements and you're going to be talking about infrastructure and because you want to borrow to perhaps make infrastructure improvements, or you don't have any infrastructure and you're like, yeah, because you don't have any infrastructure, you're doing it all manually, that a banker may look at that. And this is why it's important for you to consider what your infrastructure investments are. So you might be thinking, well, if infrastructure is so important to the business, why does vision come first? Is it just because it spells Viper really neat? No, because let's face it. Like Jeremy, for example, if you have a vision for laying on the beach in Spain for 2 months out of the year, rubbing cocoa butter on your belly, that's a fine vision. The problem is, if you set up an infrastructure where it requires you to return emails and phone calls in a timely manner, that's going to be a horrible experience for you when you're trying to lay on the beach for 2 months out of the year rubbing cocoa butter in your belly, right? So everything goes back to that main personal vision. So you're going to create an infrastructure that's going to be in alignment with your vision for the future. So that is the infrastructure. So we talked vision, we talked infrastructure, let's talk process. Process is simply how you do stuff. And it's things related to both tactical and strategic. Tactical is just the basic stuff you do every single day, the boring stuff. The tactical, your standard operating procedures, your checklists, your day-to-day activities, things like that. Your other side of the tactical, the tactical is your strategic. So again, think of the tactical and the infrastructure, right? That's kind of the ship that you built. The strategic is how you're going to take that ship out of the harbor. So when it comes to strategic planning, you think of your people that you're going to need, or the people that you're going to target, right? You need the certain people on your team, and you need the people that you need to identify the people who are your client avatar. You're going to think about the purpose of your strategic plan, which should also be in alignment with your core purpose, right? That keeps you from wandering too far off the reservation. And then finally, you've got the promotion piece. This is where you're going to be communicating this not only to the people outside your organization, but to the people inside your organization. Have you ever worked at a place that did not communicate well, and you're like, oh, are we running an ad on something, and they didn't promote it internally? They didn't tell you about it. You just get people calling you up asking for the promotion. You're like, I have no idea what you're talking about. Yeah, that's why you need to promote externally as well as promoting internally. So really quick summation of that, and that is about process, again, tactical and strategic. So let's get to execution. The execution is the reason I'm leaving this. I wasn't going to go through this, but I decided to leave it in here because execution is so incredibly important when it comes to the good running of a business, especially in the lead generation and sales function. This is one of my favorite quotes by General George S. Patton. A good plan violently executed now is way better than the perfect plan executed next week. And the reason for that is because most plans fall apart in their execution. That's why I have it in there. Part of the problem with that, especially with the entrepreneurs and business owners, is you have all sorts of different business ideas, and everything all of a sudden becomes a priority, right? You have that to-do list of like 39 items that you're going to try to get done today, right? Well, the problem with having too many priorities is it has the same impact as having none. So this is the reason why I come up with the daily 5 when I am looking at the things that I'm really trying to focus on that really are the needle moving activities. What are the needle moving activities? This right here is a needle moving activity. So when it comes to the daily 5, I'm looking at up to 5, not like multiples of 5, but up to 5 highly specific actions that you can take, which are going to move the needle towards your vision or your strategic plan, one of the two. So when you're looking at these things, like this webinar right here is a highly specific action that I'm doing. I usually do a webinar every day. So this is one of my daily 5 actions. It's not like check email or check voicemail. That does nothing for me. So what I'm saying is you have to be really clear about what your daily 5 actions and activities are. And to be honest with you, I like 3, daily 3. If I can have 3 things, I can do 3 every single day. I can't do 5 every single day. I just get burned out. But and they're not always the same 5 items or the same 3 items, but they are the things that are the high needle moving activities for you. So that is execution. The last is reporting, and reporting is going to be something that's going to be very interesting to your banker. So when you're going and you're applying for this loan, they're going to be interested in the financial metrics specifically, but it's also important that you report other metrics as well. And these metrics are both lead metrics and lag metrics. Lead metrics are just the base, they're your actions and activities. They're going to track what, or not they, you should be tracking your actions and activities. So how many phone calls did you make? How many people did you reach out to? Those are the actions that you have direct control over. You don't have any control over the lag metrics. The lag metrics might be the number of sales that you got. You don't have any direct control over sales. You have indirect control over sales, meaning how many people you reached out to directly correlates to how many number of sales you got. Make sense? So it's really important. Yes, the banker is going to be looking at the lag metrics, but it's really going to be important for you to be paying attention to your lead metrics because those are the activities that drive the lag metrics. So if your results suck, guess what? Either do more of your lead metrics until you get 1,000 data points, like between 1,000 to 1,500 data points. And once you get that number of data points, if it's still not giving you the results you want, that's when you pivot. Okay. So no sense in keeping doing the same thing and just banging your head against the ground. So all of this thing, and again, when it comes to the psychology of business, I'm not going to get into the psychology because there's internal and external and personal and individual psychology, also related to business and organizational psychology. That's outside the scope of what we're talking about today. But bankers, at the end of it, they want to feel like you're a good risk. And you're like, and I put the word feel in there on purpose. They want to feel like you're a good risk. Because at the end of the day, they have bank examiners to answer to. They have a board they have to answer to. They often have a loan review committee that they have to answer to. So if they're making a bad loan, it's going to reflect on them. So you got to give them a lot of different ways to say yes and make them feel comfortable. So let's talk about the 4 core functions of business. Sorry, these are, what happened to my, sorry guys, oh my gosh, sorry. Hang on one second here. Give me 1 minute, guys. I don't know what happened to my slides. So the 4 core functions of business, we'll just do this. So the 4 core functions, let me take this down while I figure out what happened to my slides. All right, we can do this without the slides for right now. So the 4 core functions of business are lead generation, sales, operations, and accounting. And your organization, the customer's journey through your organization happens in that order. First, they experience the lead generation, then they experience the sales, and then after that, here we go. I found the slide. Sorry, I don't know what happened. There we go. Okay. So the four core functions of business that are lead generation, sales, operations, and accounting. And your customer's journey through your company happens in that order. So it's really important that you recognize the role that this plays for all of you, of the people inside your organization. So the four core functions of business, you've got to have all of these areas dialed in, and they've got to be really, they, especially if you're going to be asking a bank for money, they want to know that you're a good risk and that the lead generation function is dialed in and the sales function is dialed in and that the operational function is running efficiently and that you have a clean set of books when it comes to the accounting function. So when we're talking about clean set of books, let's talk about the financials, because that is going to be really important to them. And again, for those of you who don't feel like you're super, let's see, adept at understanding balance sheets, I'm just going to go through a very, very quick tutorial on this. If you are interested, and I'm just making this point right now, if you are interested in understanding your finances, your money, your finances, and all sorts of things at a much deeper level, I have a very reasonably priced course at the end. It is unbelievable. It's an unbelievable deal. I'm just letting you know. It's not hundreds of dollars when I say, oh, it's really cheap. It's not hundreds. It's not thousands. It's not hundreds. It's actually extremely reasonably priced. I'm just letting you know what that could look like. So if you're interested. So I'm going to take myself down here so you can see. This is a balance sheet. This is a sample balance sheet that you would see. And it's got the assets listed at the top, the liabilities listed there in the middle, and of course the total equity there at the bottom. I just want you to understand that the balance sheet is a snapshot in time for your business. So what does it do? It actually tracks all the balances in your business. You may think, I wonder why I call it a balance sheet. Well, they call it a balance sheet because it tracks the balances. What's the balance in your checking account? What's the balance of your accounts receivable? And what's the value of the vehicles and the real estate and so forth. Now, when I say the value, that's generally listed at book value, meaning the price you paid for it at the time of acquisition. So I'm not going to get into other things that they do. You can mark them to market or have accumulated depreciation and things like that. I'm not going to get into any of that stuff. I'm just letting you know this is a very basic balance sheet, and this is what a very basic balance sheet could look like. So let's get into this. I'm going to get into a little bit of details. You'll be fine. You'll be fine. Okay. I'll metaphorically hold your hand. It will not be weird. This will be easy for you to understand. So let's look at the assets really quick in terms of the balance sheet. Again, this is a snapshot in time. This is one moment in time when you're looking at the balance sheet of your business. So it could be at the end of the month. It could be at the very beginning of the month. Generally, the balance sheet tends to match the last day of the income statement that's been printed. So I'll get to the income statement here in a second. The balance sheet, let's look at the assets. The assets are what you own. That's what you own in the business. So you own the money in the checking account. You own the accounts receivable, which is money due to you from your clients that haven't paid you yet, right? Maybe if you're selling to them on credit, where they say not credit card, that would actually be counted as something different. But I'm just saying, like, accounts receivable is if they owe you money and they haven't paid you yet. Okay. So vehicles, like I said, let's say you bought a 2019 Ford van and you paid $29,970 for it. That's where it would go on the balance sheet. And then last would be real estate. And let's say you bought a warehouse, you own a warehouse for $275,500. So I get this question a lot. I get a lot of people who watch me internationally, which is incredibly humbling. I have no idea that there were so many people overseas that were watching this. Yes, it is listed. This is listed in dollars. It could be US dollars. It could be Canadian dollars. It could be Australian dollars, or it could be euros, it could be pounds, it could be whatever. This all follows what's called GAAP, Generally Accepted Accounting Principles. That doesn't really matter though. Just letting you know, this tends to be listed from the most liquid to the least liquid. Most liquid meaning the most convertible to cash, all the way down to the least liquid, which means, yeah, it would be kind of hard to convert your real estate to cash because you got to find a buyer and then you got to go through closings and inspections and all the things, right? So I'm just saying, this is how you would expect to see a typical balance sheet. And this is how you would expect to see assets listed on your balance sheet. Your liabilities, these are the things you owe. These are the things you owe to others. Remember, assets are what you own, like you own that and it's titled in your name. So a lease would not be something in your name, right? But a liability is something that you owe to other people. So if you have a credit card balance, that maybe even if it's a personal credit card, but you're kind of using it for your business, this would be a credit card balance that would show up on your balance sheet. Accounts payable to the vendor. Let's say that you borrowed, let's say you're an HVAC provider, right? HVAC, and you purchased rolls of copper so you can use them for line sets. Well, you would owe them $37,500. You haven't paid them yet. Okay. So again, just like it's the opposite of accounts receivable. So basically you are on their accounts receivable for $37,500. Make sense? So the Wells Fargo van that you purchased several years ago, you still owe $11,570. And then Citibank, you have a real estate mortgage of $105,350. So adding those all up, total liabilities is $189. And total equity is the assets minus the liabilities equals the total equity. So conceivably, if you sold all your assets, paid off all your liabilities, this is what you would have left over. Okay. So let's look at, this is the balance sheet that we talked about. And again, this is a snapshot in time. So in other words, if you took a picture of your business in the beginning of the day, you paid a bunch of bills, you brought in some checks, and you ran up some stuff on your credit cards, at the end of the day, the balance sheet would be different. Okay. So that's important to understand that it is truly a snapshot in time. When you're looking at your income statement, this is also known as a P&L. Okay, so an income statement is also known as a profit and loss or a P&L. They are exactly the same things. It's just a difference in vernacular. So the income statement, where that was made up of three parts of the assets, the liabilities, and the equity, the income statement is made up of revenues, expenses, and net income. So let's look at the income statement. Again, this is a very basic income statement. So when you're looking at your income statement, you're looking at your revenues at the top, the expenses there in the middle, and your net income at the bottom. Let's look at the income statement at the top. So this is where you're going to break out the different types of revenue that you have that's coming in. So let's say that you have product sales and you have service sales. Okay, so let's say for argument's sake, again, maybe you're a plumber and you sell products. Like, again, maybe you have water heaters in your van, and you're going to sell those water heaters, okay? Well, you also get paid to install said water heaters, so that would be service. The water heater would be product sales. Your installation would be service sales. So why would you break these out? Why would you make two different categories for them? It's important. It's important to recognize that when you're breaking out product sales and service sales, so you can see and start to track which one is more profitable. Am I wasting a lot of money on product sales, or should I be doing more on service sales? You know, where am I making more money? This is important to track. So when you see that little percentage off to the right there, where it says 65.8% or 34.2%, that means that the product sales are 65.8% of your total sales. So just take 75,000 divided by 114, that's 65.8. So if anybody wants to check my math, you're welcome to. Or service sales is 39,000 divided by 114, again, 34.2% of sales. So this is important for you to track, because if you go from month over month, the total sales number is going to move around, right? So let's say the next month you have 150,000 in total sales and product sales goes up to 85,000. You could say, well, did the percentage change? Because if the percentage went down, you'd say, oh, well, my total sales went up, but my product sales actually went down as a percentage of total sales. So you actually have apples to apples comparisons when you're looking from period to period. So it's really, really powerful thing. And that's actually a tool that chief financial officers use all the time. So let's look at expenses. Expenses are basically the things you paid for over this period of time. So if I didn't make this point earlier, balance sheet is for a snapshot in time. Income statement is over a period of time. It could be for 1 day, it could be for 1 month, it could be for 1 quarter, it could be for 1 year. It could be for really whatever period of time that makes sense, for whatever you want to pull. But generally you see them for periods of 1 month, 1 quarter, and 1 year generally. So, but you can run them, or even run them year to date. You can run those things. But the point, generally, whatever the last date of the income statement, the balance sheet will generally also be printed for that period at the end of that income statement. So I'm getting ahead of myself, but again, when you're looking at expenses, you've got things that you paid for during the period that during the month. So you bought raw materials, you paid for insurance, you paid for insurance, You paid interest on your mortgages and your van loan. You've got commissions that you paid to your salespeople, and you've got wages. So again, if you're looking at those percentages on the right side, that's a total percentage of sales, right? So the 114,000. So then you look at the very bottom where you've got your net income of 15.5%. That is your 15.5% profit margin, which is again 17,000 divided by 114 is your profit margin percentage of 15.5%. Okay, so this is the income statement, and this is what the bankers are going to use when they're going to start to calculate different things if they're going to loan you money. Okay, so what are bankers first and foremost? What are they going to ask for? Let me just point this out. If you are outside the U.S., I am out of my element. I don't know what bankers ask for outside the U.S. I'm sure it's probably something fairly similar. But in the United States, this is the only thing I can speak on because I have no idea. I've not ever worked outside the United States in terms of getting bank funding. So I'm sorry to let you know, but this is going to be U.S. specific. So generally, bankers are going to ask for 3 years of tax returns right out of the gate. So make sure you have those ready. They're going to ask for something called a personal financial statement. And that personal financial statement is basically like a balance sheet, but for you specifically. So they're going to say, what are the things you own? What are the things you owe? And what kind of money do you make? And generally, all of that is put on one personal financial statement. If you're looking for that, you can easily Google something and find personal financial statement. Or if you'd like I've already got one in the course if you're interested in that, and it shows you how to fill that out as well. So, and then you're also going to be looking at company financial statements. Sometimes they don't ask for company financial statements depending on the size of the loan. The company financial statements that I was just referencing are balance sheet and income statement. They may ask for both. They may ask for tax returns and they may ask for company financial statements, even though they show basically the same things. They're going to try to reconcile one against the other. That's what they do. As an underwriter, we used to ask for that stuff all the time. So in terms of what bankers are going to ask for, they're also going to ask for something known as a Schedule E. And this is typical if you have rental properties or any sort of royalty income that comes in. They're going to want to see that. They'll also ask for a Schedule C, and this is true for sole proprietors, single member LLCs. That's something that you can expect to see. Or they'll ask for a K1 or a corporate return. K1 is like if you have pass-through entities like partnerships, S-corps, or if you're the beneficiary of an estate or a trust. If you are a C Corp, they're going to ask for an 1120. If you're an S Corp, they're going to ask for an 1120S. So these are the things that they're going to ask for. So do not be surprised when they're like, oh my gosh, they're asking for all this stuff. Yes, they're asking for all this stuff. And if you have this ready for you up front, it's going to save you a lot of headache than having to go back and track this stuff down. So depending on the type of business that you're borrowing under, and keep in mind, I have a background in real estate, so I looked at all of this stuff. I've seen both of this. So there's two different things that they're going to look at, either EBITDA or NOI. EBITDA is earnings before interest, taxes, depreciation, and amortization. I'll explain it more here in a second. Or NOI, which is net operating income. Generally, you're going to be looking at EBITDA and I'm also going to show you how to calculate DSR. Sorry, I meant to bring that up. So I'm going to show you how to calculate all this stuff using, debt service coverage ratio. So when you're looking at EBITDA, what you're doing is you're taking net income and you're going to add back the interest, the income taxes, the depreciation, the amortization, and that's how you're going to get to EBITDA. That is how they're going to figure how much of a loan they're going to give you. And they're going to take these numbers directly off your income statement. So when you're looking at your income statement, they're going to get to the bottom. Remember where the 15.5% profit margin was, right? The 17,000, I think it was what it was. They're going to take that and they're going to add back interest. They're going to add back income taxes, not property taxes. I'm just letting you know. So if you're paying property taxes, like on that warehouse that was on the balance sheet, they're not adding that back because that doesn't get added back. They are going to add back depreciation and they're going to add back amortization. Why do they add all these back? That is fundamentally way beyond the scope of this. I'm just letting you know this is the industry standard. They come up with a phrase called EBITDA, earnings before interest, taxes, depreciation, and amortization. If you're wondering what the difference between depreciation and amortization is, I'm glad you asked. I'd be happy to tell you. Depreciation is the writing down of a physical asset from its useful life. So let's say, for argument's sake, again, you bought a van and the van has a 5-year useful life. And let's say that you paid $50,000 for this van. You can, using straight line depreciation, write down $10,000 each year off of the useful life of that van until the end of year 5. There's basically on paper, it's not worth anything. Okay, makes sense? That's depreciation of a physical asset. Amortization, on the other hand, is the writing down of a non-physical asset, which might be like an insurance policy or like a loan. Like if you loan someone money, that's a paper instrument. So that gets amortized over time, basically for the same thing. Like think of the amortization of your mortgage loan. It's the same thing. It gets amortized over the course of 30 years. It happens the same way. So depreciation is a physical asset. Amortization is a non-physical asset. So hopefully that makes sense. All right. So when you're calculating DSCR, which is the debt service coverage ratio, all you're going to do is you're going to take the EBITDA divided by the proposed amount of debt service. So let's say, for argument's sake, and that equals your debt service coverage ratio. So let's say, for argument's sake, and generally you have to think about this like, okay, so if I'm making monthly payments, you have to match it up to the monthly income statement. Don't take like an annual income statement and use that number. You want to use the number that's going to match the payments that the bank is going to want. So if the bank wants monthly payments, you're going to use the monthly income statement. Stands to reason. So you're going to, let's say for argument's sake, that you make $3,000 in EBITDA, and the debt service that is proposed, it's say, okay, so you're going to borrow whatever the amount of money is. Let's say it's, $500,000, or that'd be a lot. Well, let's say it's $500,000 and it's going to pay $2,000. You're going to pay $2,000 a month on that. That still doesn't sound right. Let's say $350,000, whatever it is. You're going to borrow an amount of money. It's going to be $2,000 a month. And so what that is debt service coverage ratio of 1.5. I would tell you that that's pretty healthy debt service coverage ratio. Anything generally over 1.2 or 1.25 is pretty healthy. But banks will find some ways they'll just want to make sure that they're covering their butts. They want to make sure that it's a good risk. So generally for me, if I'm looking at a debt service coverage ratio, if I'm looking to bring something to a bank, it's generally going to be a pretty healthy debt service coverage ratio. I'm not going to bring them junk. I want to make sure that they have a winner on their books. So that's what I'm looking at. So that's the underwriting and lending side of things. The NOI, when you're looking at NOI, you're going to be doing the same thing with net operating income. Net operating income is a little bit, again, it's not that hard to calculate NOI. It's just you have to look at that from the purpose. It's a difference between loaning between a business and loaning for real estate. So again, you're with the NOI, net operating income, you're going to do the same calculation. We're going to take NOI divided by your debt service coverage ratio, and you're going to come up with your debt service coverage ratio number, which is 1.5 or 1.25 or whatever it is. Okay, so the calculation is the same. All right, so let's look at some success strategies. So this is all that I have. If you guys have any questions, I have quite a few people on LinkedIn. If you are interested, if you guys want to type in any questions, I don't have any new material. I do want to just share with you really quickly. If you are interested, the Advanced Money and Finance course, and this is everything that I have put together for everything that I have just talked about, and it gets into the granular details of actually how to do these things. There's all sorts of different money templates, which are going to walk you through different examples of chart of accounts and balance sheet examples, basic income statement examples, a little bit more advanced from what you saw today, but you'll be able to play in there because it's an Excel spreadsheet, and you can download that Excel spreadsheet and put it on your computer and you can play with it. There's a balance tracking template of how to actually track your cash, because tracking your cash is a lot different than checking your cash. When you're tracking your cash, this is actually something that will inevitably make your business healthier because you're paying attention to it. And where your attention goes, money flows. So you start to pay attention and start tracking this over time. I'm telling you, this is a fantastic way to make sure that your cash balances are always going up, and it's just really helpful. I show you several different underwriting examples using both EBITDA and NOI. There's the personal financial statement that I mentioned earlier. So if you are looking to have a personal financial statement and actually how to fill this out, there's an example in there for you. There's also the debt service coverage underwriting for real estate specifically. as well as one for business. So I don't think I've got a slide for that, but there's one for business and one for purchasing real estate. So these are all the different, these are all backed up. So there's not just the money templates, but they are all backed up by a series of videos to walk you through on how to do all this stuff, from balance sheet basics, income statement basics, lending basics, borrowing as a business, what types of collateral that you're going to need, how the lenders even discount or advance based on collateral, the type of collateral you're going to need, and just all different, even just different things around what's called a UCC1, a Uniform Commercial Code. What does that even mean? There's all sorts of different things there. There's calculating EBITDA, calculating DSCR, and also around your FICO scores. Let me ask you something. How many different credit scores are there? If you're saying 3, I understand why you're saying 3. However, you'd be wrong. Okay. And the reason why most people say 3 is because they think Experian, Equifax, and TransUnion. And that you'd be right. There are 3 reporting agencies, but there's about actually 9 or 12 different scores depending on what you're looking at. There's a unweighted FICO score 8. There's a FICO 5, 4, and 2 based on if you're looking at a mortgage score between Equifax, Experian, and TransUnion. There's a FICO bank card 8, which is what the lenders use when they're giving you a credit card. There's a FICO auto loan score 8. There's actually a FICO 9. And soon there'll be a FICO 10. So all of this stuff is in development, and some lenders are using 8, some are using 9. But the point is, you've got to know how to look at these things and which scores actually matter. Because you may be looking on Credit Karma and you go, yeah, I've got a 735. And then you sit down in front of your lender, you're like, dude, you're like at a 620. And yes, they can vary that much depending on if you're looking at the unweighted FICO 8 or the FICO 5, 4, or 2. So it just depends. So this is important for you to know, and we'll walk through all that. Again, this is more about the money templates, the chart of accounts example, balance sheet example, all of this stuff in here. This is all stuff that I have talked about. This is something I haven't mentioned before, is the capital expenditure calculator. This actually helps you figure out how to calculate capital expenditure the right way, and not just, oh, I'm going to use 10% of some weird number. And actually, so this is really important for people who are in the real estate game and actually calculating capital expenditure the correct way. We'll talk about accounts receivable aging, accounts payable aging, and all of these different things. So all of this stuff in here, not to mention how credit scores actually work, and metrics that every business owner must know, and how to start to create advanced metrics in your business, even using a flash report, daily ROIs, your aging reports, things like that. We start talking about a loan constant and how you can use loan constant to also pay down debt while also managing your risk. So using loan constant is a very powerful thing, and you can do that by using this specific debt tool. All of this here is $37. Oh, I also talk about infinite bank, but all of this here is $37, and it comes with a full 395-day satisfaction guarantee. So what sounds kind of wonky, right? Why 395-day guarantee? It's because I give you 30 days to go through the course. I mean, you can take as long as you like to go through the course within the 395 days. But the thing is, you go through the course, and I'm going to give you a full year to implement that. So again, if you go through this and you're like, well, I have gone through the course and I am really, you have a full year to figure out if I'm full of crap, or you just don't like what it is I had to say, you just email me and I'll give you your money back, no questions asked. And that's just $37. So let me go ahead and put this up there. Sorry, I had to reboot my computer, and here it is right here. So if you are interested, you can go to this link right here. And like I said, if you buy today, and I know there are several of you on this call, give me one hot second. If you are interested, all you have to do, if you go and you buy this today, and if you buy it before the end of the call, there you go. So let me just make sure that works. You can click on that Oops, sorry, that is not the right one. That is your business book. Sorry, I am having a heck of a time today with my internet here. That's what I'm looking for. Okay, sorry. Sorry, guys. I had all this stuff so well organized until I had to reboot my computer right before starting, and that was not working out. Okay, let's try this again. So here is that. This is that's the one. Okay, sorry about that. So you can ignore the other one. So if you're going to this one, this is the Business Owners Money and Finance course. If you are interested, if you go ahead and you buy it, I'll give you like 20 minutes. If you buy it within the next 20 minutes, I will give you a coaching session one-to-one with me, and we can talk about really whatever it is you want. There's also an onboarding call that comes with this, just so if you need it, you can utilize that. But really, this is actually a full strategy call. You and I hop on a call for 30 minutes, and we can talk about really whatever it is that you want. It's not a sales call. I'm just offering that. So we'll say till 20 after the hour, and if you are interested, you can do that right now. So that is all I have. Now, I don't see any questions popping up. I'll hang out here for just another second if you guys have any questions. All right. No questions are popping up. Thank you guys for sticking around. This has been a lot of fun. Thank you for all the wonkiness today. My goodness. The slides were messed up. Cats sleep with dogs, everything. But we made it through. So hopefully this is helpful. And hopefully I'll see you guys in the next video. And I will see you guys in the boardroom. Take good care.